Well, good morning again. This is Chuck Coldwell, Vice President, National Director of Consulting and BOLI Services for PENTegra. I welcome you to this morning's PENTalk. And today we're going to talk about the Defined Benefit Plan's annual actuarial valuation report. So without further ado, I'm going to get into this. The agenda for today, and we'll run about 40 minutes. If you have questions, please feel free to type them in and send them along the way, or you can wait to the end, whatever's convenient. But what I hope to do today is to talk a little bit about PENTegra briefly up front, a little bit about the plan that you participate in. Obviously, I want to spend some time talking about the valuation process and timing, the principal plan year results, which are important, and how to interpret them. We'll talk a little about projected costs, and then I'll close with a brief summary at the end of the report, which talks about your plan provisions, and we'll just go from there. So you participate in a defined benefit pension plan, and it's one of the programs offered by PENTegra. The official name is the PENTegra Defined Benefit Plan for Financial Institutions. It's gone through a number of different names over the years. We also refer to it, and you'll see this in writing occasionally in our newsletters, MEDB, which is nothing more than Multiple Employer Defined Benefit Plan. And that's one of the key distinctions in the program that you participate in, is this is a multiple employer plan. What does that mean? It means we have a single pension trust with multiple participating employers. And this was set up in this fashion to offer significant economies of scale to our participating employers and to structure it so that PENTegra and not the client had the principal fiduciary responsibility of managing the program. Back in 1943, the multiple employer pension plan was developed by the Federal Home Loan Bank system, primarily for their use, and then over the years it was extended to the savings and loan industry and ultimately to the entire financial industry and organizations serving it. But it became a very large program, and today it's got over $3.3 billion and over 200 participating employers. But it also offered, because of the single nature of the program, it offered very large economies of scale from a cost standpoint, from an investment and actuarial standpoint. We can do things that really only the very largest corporate plans in the country can do, and for a very low cost. So one of the things that our Federal Home Loan Bank system said was we wanted to create a plan that permitted participating employers to participate, but without the principal fiduciary responsibility, especially as it comes into play with your investment program. So our president serves as the ERISA named plan administrator. Our board serves as the plan sponsor and principal fiduciary. And the program has a board that is made up of participating employers. So what we are able to do is to relieve our clients of the principal fiduciary responsibility, and specifically around the investment management. It is our board, it is our investment group that sets the investment policy. We are the ones that determine the asset allocation models. We are the ones that hire and monitor the investment managers and obviously evaluate performance and ongoing costs. But in addition to this unique fiduciary role regarding the investment management, our CEO also serves as the ERISA named plan administrator. What does that mean? That means PENTegra is responsible to keep this program in compliance with all IRS and DOL and any other pension legislation that comes into play affecting your program. If you were to open up your summary plan description, which is the employee booklet that we provide to the participants, you would find PENTegra's name in the back of that booklet as the ERISA named plan administrator, not the bank's name, not the client's name. And that is one of the unique aspects of participating in this multiple employer pension plan. As a matter of fact, we have a sister program. It's a multiple employer contribution plan, which many of you participate in for your 401k plan, similarly structured. So it's this unique fiduciary role that really sets the plan apart from a single employer plan. A little bit of background about the plan. Obviously, it was created back in 1943, and today it has over 37,000 participants and over $3 billion in plan assets. And that covers a little over 200 participating employers. I thought you might be interested in this number, and we'll get more into these kinds of numbers when we talk about specific valuation results. But overall, the plan is over 100% funded, 103.6% funded. That means assets exceed liabilities. And we'll get into a lot more detail about funding ratios in that. So let's start. A little background on PENTalk, but obviously we're here to review the annual actuarial valuation report. So let's start with timing. If you remember, the last bullet on this particular slide, the plan year for this program is a July 1 to June 30 plan year. So as such, we start talking with outside actuaries in May and June. We start gathering data and finalizing data in June and July. And ultimately, our goal is to get out that annual valuation report to you in October. But prior to that point, what we will do over the summer, as we've done in past years, is we will draft out a newsletter for our clients, kind of giving you a State of the Union address as to where we think plan costs are, what's been going on during the year, and when you can expect valuation results. That third bullet may not apply to all of you, but if your employer has a quarterly contribution due, which is due by October 15th of every year, that letter comes out at the end of September. And again, not every client will receive that letter. If you don't have a quarterly contribution due, then you won't get the letter. But that contribution is a function of your prior year's contribution requirements. So if you're overfunded at the time, you probably are not receiving a September letter regarding a quarterly contribution. Ultimately, what we do is you get the full report, which we're going to highlight today, somewhere between mid and late October, which for those of you who've been in the plan for a while, a couple of years ago, we used to send out a summary valuation report, you may remember, September, early October. That was probably a 4 to 5 page letter giving you the principal results, and then the full valuation report would come out in November. A couple of years ago, we changed that to try to get out the full valuation sooner. We eliminated that summary letter, so now the full valuation is sent to our clients the last part of October. So what do you see? When I first started in this business, the annual valuation report was a single page. We're now up to 30 and 40 pages. That's a function of pension legislation over the year. The complexity of these programs has dramatically increased as Congress keeps tinkering with these programs. So now it's a very long report. It has a wealth of information in it. What I'm showing you here is simply the table of contents. So when you look at a report, there's a couple of pages, and we're going to focus on those pages which I think are primarily important. The principal valuation results, you can see that under introduction, and it starts on page 3, little I. We will look at that today as well. Projected costs. Those projected results are under section 4 here, pages 10 and 11. Those 3 pages, along with the wire instructions and an executive summary, are the principal elements of your valuation report. Today, I'll also just briefly touch on that last section, 8, which is the plan provisions, because at the end of all these reports, we do summarize the principal plan provisions that are in effect at the time of the valuation report. So that serves as a pretty good summary as well. So again, one of the front pages of your valuation report is called Executive Summary. And on these pages, we are highlighting the elements of the valuation report. Okay? We will show you a range of contributions. And a lot of people are confused as to timing of payments. It's your full valuation report, which you receive in October, that lays out your payment schedule. As you may or may not remember, subject to the quarterly contribution requirement that's due October 15th, many of you, your first payment is not due until 12/31. So as a payment option, you will find that you can make a single payment, which many clients do, which is due 12/31, or you can start a series of installment payments. And then there's 3 installment payments, which is 12/31, the end of February, and the end of May. So you select what payment schedule works best for you. We talk about a long phrase here, the Adjusted Funding Target Attainment Percentage, or AFTAP. That came out of pension legislation. But basically what that's telling you is the funded status of your plan. And fortunately or unfortunately, pension legislation talks about a lot of different funding statuses, depending upon the purpose. Could be as simple as that 4th bullet, which says market value of plan assets divided by funding target. And when you see the word funding target, that's talking about your plan liabilities. That's synonymous. So we also talk about funding levels. We talk on executive summary, projected costs for the following plan year. So I'm looking at the 7/1/16 valuation report as a sample for this presentation. You're all aware that it's a July 1 plan year, so obviously we're now working on the July 1, 2017 plan valuation results. But for the purpose of the presentation, we were looking at last year's valuation, so we also showed you 2017-18 projected results. We showed it to you on 2 bases. When you see HACFA, when you see MAP 21, those are pension legislation that affect the funding requirements under the pension plan. So when we showed you the projected costs, we showed you with and without an updated mortality table. And as you may remember through various newsletters, we've been talking about an updated mortality table coming soon for the last couple of years, and it gets postponed, but we do believe an updated mortality table will come into play for the 7/1/18 plan year. So what we did last year is we wanted to show you projected basis costs for the next year, both with and without that updated mortality impact. And I'll show you a little bit more detail in a few minutes on that. So as you go through your valuation report, again, from my perspective, the principal valuation results, which are summarized on page 3i, is where I spend the most time with clients, reviewing that page. And we're going to break that page down in 4 different sections. All right. The first section talks about employers' demographic data. That is pertinent to the client only. That is the data coming from you to us showing the number of participants, etc. The next section talks about plan costs. What is the plan costing you for the current plan year? And what are the assets and liabilities and funding levels in that valuation report? And we'll break all that down. The third element on that page is talking about administrative costs. So keep in mind when you look at administrative costs, it's a function of both what Pentegra is charging you and what the government is charging you to insure these defined benefit plans, and that's referred to as the PBGC, which is the Pension Benefit Guarantee Corporation, and those are insurance premiums. And we'll get into a little bit more detail about that as well. And at the bottom of that page, we show you what we call pre-MAP 21. Now, MAP 21 was moving ahead for progress in the 21st century. It's a piece of pension legislation that came out in 2006. And that's what your costs would look like if not for all this pension legislation. And then we added a new data point this past year called current market liability results. And I'll get into more detail in a few minutes about what that means. So this is a page 3i. And again, I keep referring to this as one of the most important pages in your valuation report. And it summarizes what I just went through on the previous slide. And I'm going to take this apart and look at these four sections individually so we get a better understanding of what's driving your pension cost and what's behind your pension cost. So the first section, and I just arbitrarily divided it where I thought it was important, is the demographic data, which is pertinent to your employer only. So as a sample here, what you're reading is this particular employer has 95 active members. They're employed, they're working more than 1,000 hours, they're accruing benefits if the plan is still accruing benefits. When you see reported annual plan salary, that's the salary as defined by your plan and the plan provisions you have in place of those 95 people. We show you inactive members. This particular sample has no inactive members. And an inactive member is somebody who is still working, but not working 1,000 hours per year. You need to work 1,000 hours per year to get a benefit accrual. So this particular sample had no one in that category. Then we show you the average age and the average vesting service for your group. And 45, 46, 47 is pretty typical in our clients. And the average vesting service, which again is measured from date of employment of your people, 14 in this case, is also fairly typical. And then you see two more numbers. Number of retired members, 14 in this case. This means this particular client has 14 people who have terminated, they've retired, and they are receiving monthly payments from us. So there's 14 of those. And then the last number, 55, before we get to the total, is 55 people that we call deferred vested. They have terminated employment. They are due a benefit because they are vested or partially vested. And they are 55 people who will eventually receive a retirement benefit from us when they let us know they want to receive it. And obviously, some of these people may have terminated prior to becoming eligible for early retirement. Others are simply deferring receiving the benefit. So in total, this particular client has 164 people covered by the plan, 95 actives, 14 people retired and in pay status, and another 55 who are due an eventual benefit. Technical difficulty here with the slide. All right, the second part of this page 3 little I talks about costs, plan, assets, and liabilities. And then we start to look at funding levels. So the top part of this section 2, target normal cost, what does that mean? The target normal cost is what it costs you for 1 year's worth of new benefits. Inside the target normal cost is also the administrative expense, which is going to be the third section following this slide. So target normal cost, again, represents expenses and a year's worth of new benefits. Then you see funding target. And again, funding target is the plan liabilities. This gets a little more complicated here depending upon how long you've been a client. You see the word orphan, and some of you may know what we refer to in these orphan allocations and liabilities and assets. An orphan is a member of the plan whose employer is no longer here. And there was a time through 2005 when an employer left us. The members were retained by PENTegra to pay eventual benefits. Even though the employer was gone, we retained assets and liabilities of those members to eventually pay their benefits. In 2005 and 6, we changed the policy here at PENTegra so that if an employer left PENTegra, there would be no orphans created at that time. So we are not creating new orphans when an employer voluntarily leaves the plan. But there are these people out there. Last we looked, there was about $460 million out of that $3 billion number of liabilities still with these orphans. And for purposes of valuation, we allocate a portion of orphan liabilities and an equal number of orphan assets, which means it's 100% funded, to our clients purely for valuation purposes. So that's why we break it out here. The pre-orphan allocation of funding target, which are your plan liabilities, are the liabilities of the employer. And the orphan liability allocation, in this case about $1.3 million, is the allocation from the orphan pool. Below that is the interest rate. And as we look at the rest of these sections for this page, keep in mind interest rates. One of the things that pension legislation has done over the years, it has made the interest rates that we are mandatorily required to use one of the most important elements of your cost. That's really what drives cost today, are those liability interest rates. So if you were to compare this interest rate, 6.14, to last year, or the year before, 2015, you would find that the interest rate this year is lower. As we look at projected costs, you will find that that interest rate continues to drop. Why? It's based on a 25-year corporate bond yield. And interest rates drop off every year. And today, we're still adding lower interest rates. Higher interest rates are coming off, so that average is continuing to come down. The lower the interest rate, the higher your liability. So the liability that's most effective and most important to your evaluation results is this 6.14 on our sample. That's what's driving your liability. To get down to plan assets, again, same theory with these orphans. You have $15.4 million in assets for the employer's participation, and we've allocated to you the same number of assets as liabilities to keep that 100% funded regarding the orphan. Below that, you have the investment rate of return. And we're coming up to June 30. June 30 is the magic date for investment return for this program. That's the last day of the plan year. So the investment return is shown here, and then we get to the plan assets and funding target. This particular plan has more assets than liabilities, so we say it's overfunded. It's 123% funded. And keep in mind, though, this is all at that 6.14% interest rate, which becomes important as we look at other sections to this. So the third section is administrative expenses. And the other items below that are employer credits, which I'll explain. So for participating employers, administrative expenses are made up of two pieces. The first two, administrative expense, participant fee, and asset-based fee, are PENTalk expenses. So the participant fee is a per head charge, and the asset-based fee is based on assets in your program. And that ranges somewhere between 40 and 50 basis points, depending upon size. The next two elements are part of the Pension Benefit Guaranty Corporation insurance premium. And that's calculated both on a flat rate basis, which is a per head charge, and the variable rate premium is a function of your funded status, but not under Section 2 that we just described, which is reflecting the pension legislation. The variable rate premium is a function of what we'll call, and we'll see in a minute, your pre-MAP 21 funding status. Because the PBGC doesn't really care about the prior pension legislation and the artificially higher interest rates that we're currently using. You'll see that when it comes to calculating liabilities, they are using interest rates in effect prior to the pension legislation. So what is that doing? Those lower interest rates are creating higher liabilities, which are creating higher variable rate premiums. So those four elements, when added together, equal a client's total administrative expense. Now, one of the things that we have talked to clients over the years about, which actually changed this past valuation year, was trying to reduce that variable rate premium by shifting contributions from the current plan year back to the prior plan year, and that in the past was able to help us reduce those variable rate premiums. As you may or may not recall, though, this past year, for 2016-17, the PBGC does have a maximum cap on variable rate premium, and we hit it as a whole, the entire multiple employer plan, so that shifting money back didn't really help reduce those premiums this year. And I'm guessing, based on projections, we'll probably hit that cap again in the upcoming plan year, and so shifting doesn't really help reduce that this year as well. And what about those last two balances? The funding standard carryover balance and the pre-funding balance. What they have in common is they're both employer credits. The only difference is timing. The carryover balance was created prior to 06 when the Pension Protection Act came out, and the pre-funding balance, if any, has been created by those affected employers after 06. They're both employer credits. They both get created because an employer, A, contributes more than the minimum required contribution. When it comes to the pre-funding balance, there's another level of access here that is required, and that is, from year to year, our actuaries will take a look at the contributions being made by the client, and it will make a determination as to whether it is permissible to add to the pre-funding balance. And if it is, we would be back in touch with you and discussing that particular option. So in this particular case, there's $155,000 of what I'll call employer credit. The employer controls, with one exception, when that can be used. And in this particular case, where we're showing you a target normal cost and a minimum required contribution that is in excess of plan expenses, you would be able to use the carryover balance to offset your costs. In this particular case, the sample that we're using today, because the plan is overfunded, this particular client only has plan expenses to pay, and a credit balance cannot be used. We have to collect cash because obviously we have others to pay, like investment managers and the PBGC premium. So those credit balances are really controlled by the employer. If they're underfunded, they can use them. If they're overfunded and your minimum required contribution is only plan expenses, you cannot use that until you're in a different situation. All right, but bottom line is those are employer credits to be used in the future at your discretion. And Section 4, which is the bottom of page 3i, now starts to make reference to pre-MAP 21, which again, MAP 21 was pension legislation passed in 06. So this is referring to what your costs would look like if we did not reflect pension legislation which artificially increased those interest rates, which are behind the liability amounts. So pre-MAP 21 results are showing an alternative contribution. And here's what I want you to focus on. Look at the interest rate. The effective interest rate here is 4.31. When we looked at your pension legislation interest rate up above, that was over 6%. So if we didn't have that pension legislation over the years, and there have been 3 or 4 pieces, we would be actually using an interest rate much lower, almost 200 basis points lower. And when you use a lower interest rate, what are you seeing? You're seeing your contribution requirement goes up. 700,000 up above, it's now over $1 million. Your liabilities go up. Your funding level, therefore, comes down. This funding target, again, using a 4.31% interest rate, that funding target are your plan liabilities. Those went up because we used a lower interest rate. And this is the interest rate we would be using if we didn't have the pension legislation in place. So what do we tell clients here? We'd like to tell clients they should consider trying to fund at this level because this is where real rates are, as opposed to up above on this page where we're showing you the impact on rates of the pension legislation that has been passed over the years. So the plan here on a pre-MAP basis is not 123% funded. It's a little under 100% funded. And then this past year we came out with a new term, this current market liability result. And what you see very quickly, you see 3 things. The The liability has gone up, the interest rate has come down, and the funding level has come down because the liabilities have increased. So what's behind the interest rates? You might have remembered I said the 6% interest rate, which we first looked at, was a function of the 25-year corporate bond yield. The 4.31 you're looking at today here under pre-MAP is a function of a 24-month corporate bond yield. The bottom of the page, when we start looking at current market liabilities, was a spot rate. That was the interest rate effective of June 30 of last year, if we just look at a single day rather than these averages. So current market liability is a closer picture to what we call a shutdown liability. If you were to shut the plan down, what would you have to pay, and what would the liabilities be based on? Well, this is getting closer to that number. And I say closer because it's not identical. When you shut a plan down today, typically you'll go out and purchase annuities from an insurance carrier to settle the liability. And the liability, therefore, gets settled upon the interest rate that the insurance carriers are using to purchase those annuities. The last time I looked at this, it looked like the annuities were using a 3%, even lower than this, interest rate to calculate the annuities. So on this page, in a summary, what are you getting? You're getting your actual cost for the plan year in the middle of the page, the section 2 I looked at. Talking about target normal cost, and the page before it gives you a minimum required contribution amount. And down below here, we're looking at alternatives. MAP 21, interest rates in effect based on a 24-month average, showing you what the cost of the plan would be if not for those pension legislation. And then the current market liability. Nobody's suggesting that you should fund based on the current market liability. That's really there for perspective, because interest rates are really what drives all of these costs. If you can fund at a pre-MAP level, that's tremendous. The plan is that much more well-funded, but you're not required to do so. So these were the summary of your principal plan year results for the plan year July 1, 16 through June 30, 17. These next two slides start to talk about projected costs. All right? So for every valuation report, we give you the current year's cost, and then a couple pages later, on pages 10 and 11 this year, we showed you projected costs for the following plan year. So page 10, which has been there for the last couple of years, pretty consistent, shows 2017 to 18 projected costs. We make some assumptions. We make an assumption that, A, unfortunately, for the next couple of years, we feel liability interest rates that drive your costs are going to continue to drop. That 25-year average is going to continue to drop, despite short-term rates going up. We assume a 5% investment return. We already know, due to prior pension legislation, that the PBGC rates, those insurance premiums, are going to continue to increase for the next several years. One thing that we do not show, which obviously we really cannot analyze until we do the valuation itself, is any demographic changes by the employer. People who have terminated, retired, died, started their benefits. That's all part of the valuation process and the data analysis that we do over the summer. And then ultimately, we do show you a range of contributions. So this is the bottom of page 10. So based on the assumptions above, we've showed you a range, and those ranges are plus or minus 5% in terms of liability. If we overestimate or underestimate liabilities, what would your cost look like? Hopefully you can tell by this screen that B, which is the middle column, is bolded. That's because that's our best guess as to where we think costs will come out in the following year. And then we show you where costs would be plus or minus 5% liability, either overestimated or underestimated. So what is this showing you? Column B, again, is our best guess. So when you say estimated target normal cost, that's a year's worth of new benefits for next year, $761,000. If I skip down to below the estimated funding target percentage, you'll note that this particular percentage is over 100%. If it's over 100%, that means we are still estimating a surplus of assets. You see that on line 3. When the assets exceed liabilities, again, for this particular client, what they only will pay, minimum required, will simply be plan expenses. Item 2 here would come into play is if you were underfunded, that is under 100% funded. And when you have an unfunded liability, the plan is required to amortize that unfunded liability over 7 years, and you would see another charge on line 2. So if your plan is currently underfunded, you will have a number on line 1. That's a year's worth of benefits. Line 2 would be an amortization charge of your existing unfunded liability, and then you would see a minimum required contribution as an estimate along with an estimated funding level. And notice that very last line, can the funding balance be used? Funding balances, those are your employer credits. Can they be used to reduce the 2017 minimum required contribution? The answer is no, because you're overfunded and your minimum required is plan expenses, and we need to have cash for those plan expenses. So one of the things we did that was different last year is we added a page 11, and we did that for one reason. We know that there are new mortality tables coming, and we thought they'd be in play already. They are in play if you have non-qualified plans, executive director plans, things of that nature, post-retirement medical. But for the qualified pension plan, the target date is next year, July 1/18. So what we wanted to show you on page 11 was a projected cost showing you the impact of a mortality table. And what's happened here? Well, the mortality table is showing us that we're all living longer. Therefore, we have to pay pension benefits longer. Therefore, there's a higher cost. So for this particular client, the target normal cost went up a little bit. It's still overfunded, so there's no amortization charge. Still a funding surplus, still assets exceed liabilities. But the funding target percentage has come down a little bit because of the increased liability. So again, we are estimating probably a 4 to 6% increase in your cost due to the updated mortality tables coming into play 7/1/18. So you have another year. So far, we've talked about what I think are the primary pages of your valuation report. The principal valuation page, which I broke down into 4 sections, your projected costs, and then we close your valuation report with a summary of plan provisions. So when you see your cost, if you look in the back of the report, the last 2, 3, 4 pages, we summarize the plan provisions, your eligibility, your definition of salary, your vesting schedules, your retirement dates, most importantly, your plan formula. If you're still accruing benefits, the formula is there telling you how you're calculating benefits, your early retirement provision, both the provision itself and the age, eligibility, and any other ancillary benefits as well. So you'll see those in the last couple of pages. So again, just in a quick summary here. First of all, I've appreciated your time and your listening. We're about at the end of this presentation, and just a very quick summary, and then certainly if there's any questions, feel free to type something in, and we'll try to get to your questions. But quick summary here, what's important for you to remember. You participate in a multiple employer defined benefit plan. What that does for you is it relieves the client of the principal fiduciary, investment responsibility, and administrative responsibility and compliance responsibility. Evaluation, keep this in mind, is not a calendar year. It's a plan year, July 1 to June 30, so we're coming to the close of the current plan year. We show you both current costs and projected costs. And this is important too. The department that I had, the consultants, we have consultants assigned to each of our participating employers. They should be reviewing this report either in person or on the phone with you every year. If you need to make changes, you work with your consultant, we prepare resolutions, etc., to make those kind of changes. If you don't know who your consultant is, you can go on your plan sponsor site under Contact. The heading right across the top of the page. You'll see Contacts, click on Contacts, and And the first contacts will be your PENTalk contacts, including your consultant. And then we also list the client's contacts below that. So any changes you need to make, please talk with your consultants. We're happy to help you address any cost concerns, plan design changes, etc. So at this point, we've used up about 40 some odd minutes. I'd be happy to take any questions. If anybody has any questions, I will wait a few minutes to see if there are any questions. Otherwise, I sincerely appreciate you listening. Hopefully you've got a little something out of this. You have a better idea of how to read and understand your valuation report. Again, thank you for being a PENTalk client as well. All right, having not seen any questions, I will again thank you for your participation, and please feel free to call your plan consultants if you have any further questions.